Welcome to the debate. Usually, when a company issues, say, 5.6 million new shares, and its stock price completely flatlines, well, Wall Street calls it a disaster.
Right. A total disaster.
Exactly. The market assumes the company is desperate for cash, diluting shareholders just to keep the lights on. But what if that exact financial disaster is actually the legally engineered fingerprint of a multi-billion-dollar bidding war? Today, we're diving into the $10 billion cardiorenal and hypertension market.
Yeah, and specifically, we are looking at the rapidly evolving landscape around Mineralys Therapeutics, ticker MLYS, and their lead asset, the aldosterone synthesis inhibitor, Lorundrostat.
Right, and the debate today centers entirely on a sudden, massive financial maneuver executed on June 3, 2026. Mineralys priced a $150 million stock offering to fund a $200 million royalty repurchase from their origin partner, Tanabe Pharma.
Which is a huge move.
It is. From my perspective, as an M&A analyst, these aggressive financial and legal maneuvers are the definitive architecture of an imminent corporate buyout. I mean, this is a masterfully engineered, legally bound setup designed to spark a bidding war well before the FDA's December 2026 decision date.
Well, in coming at it from the perspective of fundamental retail valuation, I argue that interpreting severe stock dilution as some secret M&A signal just ignores the reality on the ground. I mean, it glosses over the statistical limitations of their clinical data. It relies on invisible market mechanics. And honestly, it vastly underestimates the massive commercial hurdle of being a second mover in this space.
Let's lay the groundwork first. I look at Mineralys and I see the absolute last independent, late-stage asset in its class on the market. I mean, AstraZeneca already bought Syncor for almost $2 billion just to get their competing drug.
Right, Baxdrostat.
Exactly. Now, I understand why looking at a $150 million offering triggers panic about a desperate capital raise, but this isn't mere dilution. This is strategic asset optimization. By buying out Tanabe's perpetual royalties, Mineralys is actively cleaning up its future cash flows to fit perfectly into a mega pharma acquires DCF, discounted cash flow buyout model.
Okay, you can call it asset optimization to make it sound palatable, but the physical reality is that this offering creates immediate, undeniable, and substantial dilution. I mean, we are looking at an explicit $17.64 per share hit to the net tangible book value for new investors.
But that assumes...
Let me just break down what that actually means really quick. Net tangible book value is the physical cash and hard assets backing a company if you liquidated it today, right? Divided by the number of shares. By issuing 5.6 million new shares at $26.50 just to pay off Tanabe, the intrinsic physical floor of the stock just fell out by over $17.
Sure.
That is an immediate destruction of fundamental value if this company is forced to commercialize this drug alone.
It is only a destruction of value if you assume the company operates in a vacuum for the next 10 years. But let's look at the mechanics of why a royalty repurchase is an absolute prerequisite for an acquisition.
Okay.
Mineralys paid $200 million upfront to eliminate perpetual royalties on Lorundrostat. If you are a mega pharma evaluating a buyout, your entire valuation is based on a DCF model. You are projecting cash flows 15 years into the future and discounting them back to today. Mega pharmas fundamentally reject perpetual royalty bleeds.
Well, yeah, because it taxes their peak sales forever.
Exactly. It complicates the valuation, it shaves off peak profitability in a $10 billion market, and crucially, it leaves a third party, Tanabe in this case, constantly auditing your sales books for the next 2 decades. Acquirers hate that. By taking the financial hit now, Mineralys stripped away the messy long-term obligations. They packaged it as a clean, wholly owned asset.
I come at it from a different way. That looks great on paper, but realistically, your thesis assumes the buyer is already at the door, checkbook in hand. What you're describing is like taking out a massive, high-interest second mortgage to completely renovate a house you hope to sell this summer. If a buyer shows up and loves the new kitchen, fantastic. But if no buyer shows up, you're left living in a house with crushing debt, trying to pay it off yourself. If Mineralys has to commercialize this drug independently against a behemoth like AstraZeneca, that massive dilution is going to function like an anchor around the neck of current shareholders.
I have to challenge that premise. You're analyzing this financial restructuring as an isolated event. Mineralys didn't just wake up and decide to dilute its shareholders for a theoretical renovation. This restructuring actively forced a critical reaction from their partner.
The licensing amendment.
Yes, exactly. This leads perfectly to the next point. If we look closely at how Tanabe responded to this exact deal, we see the blueprint of an imminent exit. Let's talk about the $100 million change of control or COC clause.
Right.
When Mineralys bought out those royalties, they concurrently negotiated a new clause. It dictates that if Mineralys is acquired, $100 million becomes immediately payable in cash to Tanabe. Now, let's reverse engineer the incentives here.
Okay.
Mineralys, positioning itself as a seller, would never voluntarily propose a legal clause that effectively raises its own acquisition price by $100 million. That actively deters a buyer. Therefore, Tanabe, the original creator of the molecule, must have demanded it.
As a hedge.
Precisely. Tanabe demanded it to protect themselves against giving up perpetual royalties right before a massive acquisition is announced. They are essentially saying, we'll let you clean up the asset for your buyer, but we know a buyout is coming, and we want a $100 million exit tax. That clause is a glaring signal that the originating partner anticipates a transaction.
It's an aggressive clause, I grant you that. But look at the actual text of the amendment. That change of control clause only applies to the new milestones.
Right, the new ones.
Exactly. The exact $100 million replacing the royalty. It explicitly does not accelerate the remaining $255 million in commercial obligations that Mineralys still owes Tanabe. Let's follow your logic for a second.
Go ahead.
If Tanabe, with full visibility into the data room, was absolutely certain an acquisition was happening tomorrow, their lawyers would have demanded acceleration on every single penny. They would have locked in the full $355 million. Instead, I look at this and see prudent, standard legal downside protection.
But
They gave up a royalty stream, so they logically threw in a kicker for the new milestones just in case. Viewing a standard corporate hedge as definitive proof of an active, secret bidding war is a massive leap.
But you have to look at the asymmetric nature of what they accelerated. They locked down the exact portion that replaces the perpetual upside of the drug. But let's follow your skepticism. This bridges us to the ultimate paradox here.
Which is?
If Tanabe is legally bracing for a buyout, and the asset is perfectly optimized for a mega pharma's DCF model, it forces a massive, glaring question. Why isn't Wall Street buying the stock?
Right. The stock price is basically flat.
Exactly. If Novartis or Eli Lilly or whoever wants this asset so badly, why is the price completely stagnant? And this brings us to the irony of biotech M&A. The more a mega pharma wants to buy a company, the more legally prohibited they are from buying its stock.
You're talking about SEC Rule 10b-5.
Yes, and the subsequent standstill agreements. Under SEC regulations, the moment a mega pharma enters M&A due diligence and opens Mineralys' data room, they are in possession of material, non-public information, or MNPI.
Right, so they can't trade.
If they go out and buy a single share on the open market, it is textbook insider trading. Furthermore, the non-disclosure agreements required to even look at the data contain rigorous standstill clauses. These legally bar the potential acquirers from buying stock or launching hostile takeovers during the negotiation period. The exact entities driving the bidding war are legally handcuffed from impacting the public stock price.
I'm sorry, but I just don't buy that. Let me tell you why.
Okay.
While that elegantly explains why the acquirers aren't buying the stock, it does not explain why the broader institutional market is apathetic. If this setup is as obvious to an elite analyst as you claim, hedge funds and institutional speculators should be piling in right now, driving the price up well before any announcement.
They are piling in. But institutional buyers don't log into a retail brokerage and drop $50 million at market price. They use VWAP algorithms, volume-weighted average price.
Sure, algorithmic trading.
Let me explain how that actually works for the listeners. An algorithm takes a massive institutional buy order and mathematically slices it into thousands of tiny fractions. It executes them over weeks precisely at the market's daily average price. It is designed specifically to hide their accumulation from retail investors. It prevents the stock from jumping 10% in a day and tipping off the broader market.
Even so.
We have historical precedents for this exact dynamic. Look at Pfizer's $229 per share buyout of Seagen, or Bristol-Myers Squibb in acquiring Cardiorenal therapeutics. In all those cases, the stock prices stayed totally flat, suppressed by algorithms, right up until the second the press release dropped, resulting in a violent vertical jump.
You can explain the mechanics of a standstill agreement or a VWAP algorithm flawlessly, but you are still asking everyone to ignore a physical reality. You are asking them to ignore a massive dilution event and instead place their faith in a secret, invisible auction that we cannot empirically prove exist.
But the structure?
A silent market very often just means exactly what it looks like, a lack of interest. Relying on hypothetical bidding wars is a notoriously dangerous investment thesis, especially when you look at the fundamental commercial realities of the actual drug. Legal handcuffs don't matter if the underlying asset is fundamentally flawed or just late to the party.
Late to the party?
Yes, we cannot ignore the elephant in the room. AstraZeneca has already won the first mover advantage in this drug class. They secured FDA approval for Baxdrostat in May 2026 for hypertension. Mineralys is fighting to be second.
Okay, let me explain exactly why that first mover advantage is actually an illusion when you look at the biological timelines. This is what justifies the invisible bidding war. AstraZeneca won the initial race for hypertension, sure, but hypertension is just the gateway. The real prize, the $10 billion market, is protecting the kidneys in chronic kidney disease, or CKD.
And AstraZeneca is running a massive global trial for that right now.
They are, but biology dictates the timeline, not money. AstraZeneca's phase 3 CKD hard outcome trial, called Baxdrostat, does not finish until December 2029. They have a massive, unavoidable 3-year evidence gap before they can legally claim kidney protection.
Right.
Meanwhile, Mineralys just went to the European Society of Hypertension Conference, ESH 2026, and completely bypassed that timeline. They dropped phase 3 data from their Launch-HTN trial, showing a staggering 52.2% reduction in UACR right now.
Okay, let's define what that metric actually means before we celebrate it.
UACR is the urine albumin to creatinine ratio. When the kidneys are damaged, their internal filters break down and they start leaking a vital protein called albumin into the urine.
So measuring UACR essentially measures how fast the kidneys are being destroyed.
Precisely. And this is where the biological mechanism of this drug class is so critical. These aldosterone synthase inhibitors, or ASIs, don't just lower blood pressure. In compromised kidneys, the hormone aldosterone acts like a toxin. It causes severe fibrosis, literally wrapping the microscopic filters of the kidney in rigid scar tissue until they fail.
Right, and the drug stops that?
Yes, Lorundrostat works by targeting the CYP11B2 enzyme, which physically shuts off the biological factory that produces the aldosterone toxin in the first place. A 52.2% reduction in UACR means Mineralys isn't just treating symptoms, they are violently halting the physical scarring of the kidneys.
I have to cut in here because while the biology of shutting down that enzyme is fascinating, your framing of the clinical data is highly problematic. You are comparing AstraZeneca's ongoing, rigorously designed global phase 3 hard outcomes trial to a post hoc analysis.
It's still highly statistically relevant.
Let's explain why that matters. The 52.2% UACR reduction Mineralys presented wasn't the primary endpoint of a dedicated kidney trial. It was a post hoc look, meaning they sliced the data after the fact to find a favorable outcome on a tiny subgroup of only 84 patients. 84 patients. Meanwhile, AstraZeneca's global program is enrolling over 20,000 patients across multiple meticulously controlled trials.
But the sheer magnitude of the effect in those 84 patients.
Let me finish the thought, because this goes directly to the M&A thesis. If you are Novartis or Eli Lilly sitting on your board of directors,
Are you truly going to authorize a $4 or $5 billion acquisition based on a statistically fragile post-hoc analysis of 84 patients?
In biotech, yes.
Or are you going to demand certainty? Certainty means waiting for the strict FDA deadline, the PDUFA date on December 22, 2026, to see if the agency actually approves Lorundrostat. M&A requires concrete foundations. The statistical fragility of slicing data after a trial is over does not provide the foundation a mega pharma needs to justify a multi-billion-dollar check.
I understand why a retail investor looks at a post-hoc analysis of 84 patients and sees fragility, but let me give you a different perspective on how biotech M&A actually functions. You argue that a mega pharma demands certainty and will wait for the PDUFA date.
Absolutely.
But in this sector, waiting for perfect, risk-free data means you lose the asset to a competitor. Let's look at the precedent you brought up earlier. AstraZeneca bought Syncor for almost $2 billion precisely to skip the multi-year discovery timeline. They bought it when the asset was still incredibly risky.
But Syncor wasn't competing against an already approved drug in the exact same class. Mineralys is.
No, they are competing for the underlying platform. Because AstraZeneca went first, they proved to the FDA that inhibiting the CYP11B2 enzyme is safe and highly selective. AstraZeneca absorbed all the foundational regulatory risk for this new class of medicine. Consequently, Mineralys' regulatory risk profile essentially evaporates. The market and potential acquirers no longer view Lorundrostat as a speculative biological experiment. We know the mechanism works.
Even if we assume the mechanism is de-risked, you are still ignoring the data quality gap. AstraZeneca is not just selling a single pill. They're building an entire cardiorenal ecosystem around Baxdrostat and their standard of care drugs like dapagliflozin.
Let's explain what dapagliflozin is, because this actually proves my point. Dapagliflozin is an SGLT2 inhibitor. These are blockbuster drugs that force the kidneys to excrete excess glucose, providing baseline kidney protection. AstraZeneca is testing their ACI drug almost exclusively in combination with their own SGLT2 inhibitor. They are trying to lock patients into an AstraZeneca-only regimen.
Right.
Mineralys, however, proved in their phase 3 trial that Lorundrostat works as a highly potent single-agent add-on regardless of what other background drugs the patient is taking.
In 84 patients.
Yes, in 84 patients. But let's look at how the medical community reacted to those 84 patients. This brings us to what I call the vote paradox.
Okay, go ahead.
That 52.2% UACR reduction wasn't just quietly published in a press release. It was presented at the ESH hotline session by Dr. Lifret Vogt, a globally recognized nephrology professor. Dr. Vogt has deep ties to AstraZeneca. He is heavily involved in their clinical trials, yet here is a preeminent specialist, funded by the competitor, standing on a main stage validating Mineralys' post-hoc analysis to the global medical community.
It is interesting optics.
When the competitor's own top researcher signals that this is a practice-changing cardiorenal platform, the industry listens. Mineralys is the absolute last independent gateway into a $10 billion market. If a megapharma doesn't buy them now, they are entirely locked out of the next decade of cardiovascular medicine.
Look, while the optics of Dr. Vogt's presentation are compelling, we have to look at the actual safety profile when you start aggressively altering kidney function. The historical danger with altering sodium and fluid excretion in severe CKD patients is hyperkalemia, which, is dangerously elevated potassium levels in the blood that can trigger sudden, fatal heart arrhythmias. You cannot gloss over the safety risks of the biological mechanism.
Which Mineralys navigated perfectly. In that exact same advanced CKD population we've been discussing, Lorundrostat achieved that unprecedented kidney protection while maintaining a confirmed high potassium risk rate of just 2.4%. It is an undeniably pristine safety package that completely isolates the cardiovascular benefits from the historical risks.
Is a strong safety signal, yes. I am not arguing that Lorundrostat is a poorly designed drug. What I am challenging is the leap in logic from promising clinical asset to imminent legally engineered bidding war.
It's all connected.
The narrative you've constructed is built on linking circumstantial evidence. You are looking at a $150 million capital raise that severely diluted current shareholders, a standard contract amendment from Tanabe, and algorithmic trading theories, and you are trying to convince listeners that this is a masterstroke of M&A chess. Let's look at the actual risk. If this theoretical buyout does not happen by December, Mineralys has to build a commercial sales force from scratch.
Sure, but
They have to fight AstraZeneca hand-to-hand for market share. That is a brutal, capital-intensive war that most small biotechs lose, and they will be fighting it with a deeply diluted stock.
As we begin to wrap up, let me pull the threads together on why I believe that commercial war will never happen. The silence of the market right now is an artifact of the law, not a lack of interest. When you combine the DCF optimization of a $200 million royalty repurchase, the explicit $100 million Tanabe change of control clause, the standstill legalities that are actively handcuffing buyers, and the massive 3-year clinical gap AstraZeneca faces in proving hard kidney outcomes, well, the board is undeniably set.
I just don't see it as a sure thing.
Mineralys is structurally engineered for an exit. The evidence points heavily toward a binary buyout event well before the December 22nd PDUFA date.
And from my perspective, while the M&A architecture you've laid out is structurally elegant, one cannot simply ignore the hard financial realities right in front of us. We are looking at a tangible $17.64 per share destruction of fundamental value. We are looking at the statistical fragility of relying heavily on post-hoc clinical data sliced from a fraction of a trial. And most importantly, we are looking at the inherent, massive risk of betting on invisible auctions that may only exist in the minds of optimistic analysts. The standalone commercialization risk here is severe, and retail investors will bear the brunt with it if the music stops and there is no buyer.
I think where we absolutely converge, however, is on the profound medical impact of this drug class. Regardless of the corporate maneuvers, aldosterone synthase inhibitors have completely disrupted the treatment paradigm for hypertension and cardiorenal disease. The strategic value of an independent asset capable of shutting down kidney scarring in a market projected to reach $10 billion annually is undeniably high.
Agreed. Whether Mineralys is acquired tomorrow or forced to commercialize independently for the next decade, the science behind safely inhibiting the CYP11B2 enzyme is a massive leap forward for patients suffering from treatment-resistant hypertension and rapid kidney degradation.
So for everyone listening, as we approach that strict FDA deadline in December, we encourage you to look beyond the surface-level stock prices. Understand the underlying legal and structural mechanics of how these mega deals are actually built. Is the flat stock price a dilutive trap set to crush fundamental value? Or is it the legally mandated silence before a multi-billion-dollar storm? We will leave it to you to decide.